Hello, my name is Dr. George Mochocki, and welcome to Introduction to Business. We're almost at the end of the series, 21 chapters. You're taking me on an online class or a face-to-face class, and this is a summarization of what we ever covered in a discussion group or in our lectures in the classroom. You're utilizing the software that was included with publishers' textbooks, integrated software, so you have a good idea. We're at the end. This is something that is going required for the feasibility paper that you'll be turning in for me, either as a team, an online, or individual, depending on the course. It all depends on what they call it, how long the course is. Usually in a summer class, I do it individually. In a regular 16-week course, I would maybe do more of a team, whether it's in a face-to-face class or within a what do you call it, online setting. So you're taking me, like I said, this class is offered at community college. I'm either teaching this class at College of Lake County, if you're in Lake County, or Harvard College if you're in Cook County. Maybe a little different book, but basically Introduction to Business or Finance Management. The concepts don't change. It just may be a little different perspective. So let's go on this class. So right now this is a class you're taking, and you have the publisher. So if you just happen to find me on YouTube, or and you say, hey, I love this guy, look me up at those, either one of the colleges. If you're out of the area or you can't take me in an online class, look at your own community college to do a good job for you. Okay, so let's talk about financial management. When I look at financial management, what I always say, all of us are financial management. We pay our bills, we go to school, we pay tuition, we buy things, we acquire things. Sometimes we leverage our good credit, the 5 C's of credit. We look at terms and conditions. How do we get money to buy a new house or a new car? How do I improve my cash flow? That's basically my money in my checking account. And we're going to talk about the chief financial officer, CFO, who is in finance, what is finance, what do financial managers do, role of financial manager, what worries finance. And there's a lot of worries. Economy is the number one. The healthcare cost is another one. New taxes may come up, new regulations depending on the industry you're in. Those are all the important issue the financial manager has to look and consider, because it's going to be part of my cost, either part of my expenses, which reduces my profitability, or an expense that I can't get around because it's a government regulation. So I have to see how I can make this work in my favor. Okay, and what's in concerns and financial forecasting. Now we talk about budgets, different types of budgets. Okay, so now you already have access to my concept maps. You've taken me in a class. You have access to the second tier. Remember, you already read the material. You looked at the material. You added to it. And now here I'm going to go over, hopefully going to need an hour. And you're just going to say, hey, what did I miss? Or now it makes sense. Remember, you could always stop me, fast forward me, turn me off. Hopefully not. But you could at least always look at the concept maps and see how I, because it follows almost along with the publishers. Okay, I think this concept map here, if I had to do it with the PowerPoint, was close to 55 slides. Okay, so what's finance? And I'm going to make this just a little bit bigger for those who have it. Remember, you could always slow. Okay, I think I use 300 big enough for you could see, and it's 200. One more. Remember, those of you who had me were live. So what you see is what I would be doing in the classroom. Okay, finance. Finance, function that acquires funds, real easy, and manages them. Not only do I get the funds, how do I manage them? All right. Now, finance activities from a financial manager, but just finance in general, prepares the budgets, creates cash flow analysis. You get the numbers from accounting, but now I'm looking at different scenarios and planning for expenditures. What I need in the future to accomplish the company's goals or objectives. Okay. Now, financial management is financial management. Remember, you could always stop me, but look at this. I'll play around with these a little bit so you can see the whole screen. It's easier. You always will have my little picture right in here. Try to be more personal, interactive. Still, just more of a download. But at least you'll have a good understanding. And just in case I miss something in the classroom, you could always pick it up here with the book, the software. This short Flip the Classroom YouTube in a lecture, you'll be doing fine. managing firms' resources to meet goals and objectives. We talked about financial managers examine financial data. Remember from which one recommend strategies for improvement financial performance. When we had an accounting, we had the different return on investments. We had profitability, liquidity ratios. All that is the accounting tells me here's where you're at now. And finance or financial management or the financial team will basically come around and say how do we improve these numbers as to increase our profitabilities and shareholders' wealth. Okay, financial managers are responsible for. Ooh, look at what they do. Same thing you do as as an individual. So when you go on your resume, you can say, "Yes, I am a mini financial manager. I have a family, or I'm a single. I pay the bills, and that's all a manager does. You pay company bills, you pay your own bills, you buy merchandise on credits or accounts payable. You collecting payments from customers, accounts receivable, making investments and maintaining a cash flow that you have the right amount of cash at the right time." Collecting payments. Think of you going on vacation. You want to make sure you have enough money so you don't have to worry you get stranded someplace. Okay, staying abreast of market changes. What's going on right now? The healthcare costs going up, so that's something you may have to adjust on your budget. Assuring accounting accuracy. You remember, accounting is the language of business because what, like it or not, is the money is the inflow of cash and the outflow of cash. You're running a business now, so you have to know where you're spending your money and that you're using it wisely, effectively, and efficiently, and you're getting the biggest return on your investments. Okay, who is in finance? You got the chief financial officer, you got the certified financial planner, you got the chartered financial analyst, and you have the controller. Most of your checks and controller, he or she is the one. You look at the state; they're the one that issue the checks to make sure that the payment is legit, and they're actually signing off and going. So, chief financial officer understands finance, has a good accounting background, has to understand finance, make recommendations to top executives. Sometimes it could be both. You remember, if you're a small business and medium, you may be the president, you may wear several hats. Okay. Now, what's going on in women? 35 out of 500 companies, supportive bosses and spouses, and company culture. You have women out of 35. That number is still kind of low. You should have more women. When we talked about accounting and finance, they're both equally the same. The one thing is a male chief financial officer may take a little more risk, where a female chief financial officer is still taking risk, but more of a calculator to make sure that the numbers are there to justify the risk. Where I may just go on a hunch. I'm not saying all, please. Remember, I'm just going generally. I'm looking at an attribute or a trait that most men would have. They're going that gut feeling, and that gut feeling about like 70% of the time they may be right, but the other 30% they could lose a lot. Where women, chief financial officers are still taking risks, but more of a calculator. They're looking more like 80 or 90% to make sure that this will come back. So you may not get the highest return on your investment. I'm going to say not all, but you will always have a safe return. You're not going to lose all your money. Okay, 4 signs you need a chief financial officer. You do not have the information on key items. No one is carefully watching and analyzing your expenses, like cash flow, working capital, or forecasting. You are not aware of regulatory changes. Geez, that could affect your business. And regulatory change, it means I have to accommodate, so that means who's going to pay for it? Where is it coming from? You are unable to generate financial reports. And then here's the source. When you look at generate financial report, even a small business, if you're using QuickBooks or some of the other software programs, you'll be able to generate some reports. So if you can't do any of that, you're just running it by the seat of your pants, you should be able to generate reports. So how do you know where the money's going? How do you look? Even at home, when I do, if I use what do you call it? Chase or USSSA or Fifth Third Bank or Bank of America, whatever. They'll give you kind of here's how much you spend, here's where your money's at. To give me some sort of report, you should be able to have that. It's a requirement. You need to have the report in business. How do you know you're making money? Where's the money going? How do you know what to write off on taxes? Remember? Finance. Okay. So hopefully you have those software. What do financial managers do? Very good question. And here's a chart. And if I look at this, and it's everything we're going to be talking, they do auditing to make sure before the internal auditor comes in, they manage the taxes, they advise top management, they collect funds, credit, they control funds management, they obtain funds, how to get funds, they do budgeting, and they do planning. Everything you do in a home budget, or if you're small business, or even in your own personal life, you have to do all that. So you're kind of a mini chief financial officer. Be careful how you write that in your resume. People are going to say you're really stretching the truth. Okay, so role of financial manager, and we talked about this, right? Uses resources effectively to meet company goals. Fund managers controlling funds, credit managers collecting funds, accountant, right? Measures the company's health, writes reports. Controller is the chief accounting officer. That's nice to know in case you see it in an exam. Managing taxes and auditing internal. What worries financial? Consumer demand for their firm products go down. Come on, no customers, no business. I'm not getting any revenue. You look at your customer base, even though sometimes you get upset with your customers, maybe too finicky, may want too much, but without the customers, you have no revenue coming in. It's like you're not working. You're working for the customer. If you satisfy the customer and they like your products, you'll talk to other customers, they'll repeat and come back. Remember, it's better, it's more effective to maintain your customer base and always try to find a new customer. And use example, it's cheaper to, if your loved one, I love you, buy your flowers once a month, instead of always trying to take that person out and always trying to impress him or her. So once they know you and they say, hey, I feel comfortable with this operation, I'll buy. But if they start losing them, what do you have to do? Okay, credit market interest rates. The Fed is thinking about raising it for last year. Looks like it's almost going to have to do it. Financial regulations from the government. That's why you have the Frank Dodd Act we talked about, and the SOX requirements for accounting that all came, and now some international accounting rules that's going to be implemented. That's going to be like a baseline. So a lot of things are changing. You should be aware. It's not going to change overnight, but you should be at least aware and start lining up the organizations to meet these challenges. And in foreign competitions, always there are environmental regulations. What do firms fail? Why do firms fail financially? Undercapitalization, not enough funds to start off. Get the projects you're going to do. Make sure you have the money. Open up the business. They're going to come. What if they don't come for 6 months? When do they come for a year? And then your business picks up. You never know until you start doing it. Okay. Poor cash flow. You buy a lot, but you don't have enough to pay for your bills and employees. Ruins your credit score. Brings down your credit score, and now you got to pay more for the capital that can be utilized for marketing or buy more supplies or materials. Inadequate expense control. You're spending money and not knowing where you're spending. You got to have it in certain categories, and you have to stick with a budget that we're going to be talking about a little bit. Top financial concerns of what do you call it? Chief financial officers. And for the micro level, the smaller this affects me more at the organization. Ability to maintain margins, ability to forecast resorts properly, maintaining morale and productivity of the employee. If I got to cut, not getting raises, how do I motivate them? What else could I do? What could I promise them? What maybe I can make them offer them more 401 or help them something to offset. May not be the cash, but it'd be something else that is beneficial for them, and they could see as the company's growing that eventually I will repay them for their loyalty. And the cost of healthcare, again, that's going up. We don't know what's going on. Working capital management, everything's got to shuffle out. And I'm going to quit calling it Obamacare. It's Affordable Health Care Act, because I don't think it's going to go away. It'll be tweaked, but it has to be adjusted. So I still don't know what the ultimate cost is going to be. Okay, and then now for the macro, the larger environmental forces out there that I have to look at is consumer demand. If the economy is suffering, people aren't buying. Federal law, government policies, pressure from competitors to keep the prices down. Credit market interest rates, if they go up, then also people don't have the money. So I have to maybe look at going at layaways or some other ways of getting them to make the commitment to buy the product or put some down payment down. And global financial instability. That's always there. And you see what's going on with China for the last thing where they were kind of trying to stabilize their yen, because it dropped down, and so they wanted more of a cheaper currency, and the cheaper currency helps them because the product's cheaper. But if I'm selling globally and the dollar's strong, so how do I do to circumvent that, or to make the adjustments to capitalize on the market that's out there? And then maybe I buy from China and for the short term, and then basically replace it with another vendor supplier. Okay, now financial planning. It comes into let's see. You have three things. Financial planning involves analyzing money flows in and out from the company, just like you do in your checkbook. You check them at the year end, and your credit card. You have to. If you don't, in the finance, you have to. This is your life source. This is your money. This is your bloodline. You need to make sure. So what happened? I did it. Oh, and you couldn't do that? Doesn't he know if it's going one way or the other way? He was doing that for 30 minutes? Is he a pull-up? When did he try to think the other way? Did he get it done? Did you have to go on later? Which car? That rock? Oh, okay. It's not too bad. You like that? It's going around. Alright, Jared. Was Chamba home? Let's see what we have here. Oops. Sorry. Oh, there it goes. It got something went off. So, okay, we're going forward. Now the three. Let me just close this off. I'll make sure I was recording. The three key steps of financial planning: establishing controls, actual to projected, make the adjustments that needed. You don't wait to the year end to find out you've lost all your money. Forecasting is very important. Oh, I got these the wrong way around. There we go. Okay, forecasting first. Cash flows, short term, 1 year, and long term. The book said the author was talking about 5 to 10 years. Okay, normally usually 5 years. 10 years is a long way. Too much will happen in 10 years. But if you want to do the long term plan and you have a long term objective, but usually it's within a 3 years window, and then maybe 2 years you're kind of anticipating. 10 years is a wish dream. Okay, developing budgets. Your capital budget. That means big expenditures, cash and operating. Establishing controls, actual to projected, and make the adjustments as needed. Okay. Now financial forecasting. Let's look at it here. We have the short-term finance. This is under a year, right? Predicts the revenues, costs, and expenses for a period of 1 year or less. Remember that if you see that on the exam, or when you listen, you have to know what I'm doing. Make sure I have money now, and if I know something's going to happen, or for expenditure or some new taxes, that I will adjust my revenues for the future. But I have to start doing it now and not wait till next year. Slowly gear it up if that's the case. Okay, cash flow forecast predicts the cash inflows, usually months or quarters, and outflows in the future. You have to know what your bills are coming, accounts are payable. And the long-term forecast predicts revenue costs and expenses for a period longer than 1 year, and sometimes as long as 5 to 10. Okay. Okay, now go over here. Let's talk about different budgets. Now remember, and if you look at the, let me just remember, we already had the chapter D, the personal finance that we talked about, and so we have our own personal. I got a school budget, I have a health budget, I have a budget that I do for utilities, for insurance, for fun. So at home we have different budgets that we keep. Budget for a new car, budget for replacing the car. So we put money away in budgets, and a lot of times budgets are good because it keeps us focused on what our objectives. Otherwise, we spend the money and we have nothing because we're not using the money wisely. It's like just throwing it out. Here we're still throwing it, not throwing it out. We're using it, but we're controlling which way the money's going. That's what a budget does. So budget takes what you have and utilizes your resources, financial resources, effectively and efficiently. You're always going to hear that in business. That's the biggest thing. Okay. So what kind of budgets do we have? Let me just close this up a little. What's a budget? Management's expectations of revenues and allocations, the specific use of resources throughout the firm. Let me do it this way. It makes a little sense. Okay. Budgets depend heavily on what? The three main financial statements we talked about: accounting. You'll know these coming out of your head. Balance sheet, income statement, cash flow. All those are very important. And then I do my forecast, long and short terms on each one of these. Okay. And a budget is a guide for financial operations, isn't it? Let's make this a little more. Okay. And what did I have in here? And expect financial needs. Okay. So that takes care of budget. Let's look about what types of budgets we have. A capital budget is a capital, big, large. Okay. So capital budget is highlights the firm's spending plans for major assets that often require large sums of money. Cash budgets estimates cash inflows and outflows. Let me just move this over a little. Okay, remember you can always stop me, play back if I'm going too fast. But here, even if you I know it, write it down on your mind map. The more senses you get involved, the higher probability that you'll retain information from short term to long term. Like a short term budget to long term budget. Okay? So estimates cash flows and outflows during a particular period, like a month or a quarter. Now you take this cash budget and your capital budget, and that's what your operating budget basically becomes. Ties together all of firm's other budgets and summarizes proposed financial activities. And here's a financial graph. Here's a graph. Let me show you how it looks. So if I look at the budget, operating budget, here's the master plan. I got a short-term forecasting, long-term. I get it in here. I get a capital budget, cash budget. Because I'm looking at these numbers here, and I have financial control. Are we on target? You don't want to wait to the end. You make the adjustments like in a car. You're driving, you make a little turn, a little curve here. You're not going straight from one point to the other. You got to make the adjustments. Adjustments to keep you on the budget. So your actuals and your projected are very close. Okay, so key needs for operating funds in a firm. Okay, let's see what we have here. Managing day-to-day needs of a business. No way. Controlling credit card operations. 25% of accounts receivable, efficient collection and credit history is tied up on this. Okay, 25. That's a big chunk of your money. Acquiring needed inventory just in time, but you pay a little bit more, but you don't have to store it. You don't have to worry about damage, but will you get it in time? In the wintertime, you may want to improve or expand your safety stock because of weather condition. And if you're looking at certain areas, if you have a supplier all the way from the Midwest, the only way just-in-time inventory works if your supplier has a warehouse that's close by and has enough on hand to supply you for your operations until you find another supplier or he could replenish it. Okay, it's a gamble you're taking. Always make sure you have more than one supplier. Making capital expenditures. Alternative source of funds is debt financing, fund raised through various forms of borrowing that must be paid, and equity, funds raised from within the firm from operations or to sales of ownership of firms of stocks or bringing in more partners. Okay. Now, how small businesses can improve cash flow. Be more aggressive in collecting accounts receivable. Offer customers discounts for paying early. Come on. But remember, if I give them a discount, they pay it early. Make sure you're making money, not that you're going to lose money. I give them a discount. They give it to me like 2%, 210. You get 2% off if you pay within 10 days after I get the invoice. But then the 2% off, hopefully that money that they give me, it'll be less than if I had to take a loan out to improve my cash flow at, let's say, 6% or 7%. You see how that works? So mathematically, I can't give them 2%, but if I could get a loan for 1%, why would I want to give them a discount? It's like out the loan. I'm not making money. I'm losing money. Financial managers looking at how to improve the financial health of an organization and to make it stable and strong. If you look what's going on in the state of Illinois, would you like what Governor Rauner is doing, or whatever governor? Sometimes you got to say, hey, we're ready in the hole. We owe so much money. We gotta take control and we gotta reduce our spending. People don't like that. They're used to certain things. They don't want the taxes go up. But you have to do what you have to do. Now that's the governor. Now think of a business. A business has shareholders that they don't care to get rid of that manager or president as just like quick like this and bring new shareholders because they want to improve the cash flow. They want, so make sure you look at it to take advantages. What I'm trying to say, if you're looking at payments, discounts, make sure you're making some money out of it, or at least breaking even, or at least it's to your advantage. Breaking even is not worth it unless, well, it could be worth it because you could write some of it off for as a promotion to get customers to pay earlier, get used to that, and improve your cash flow. Remember, finance. What I've learned in finance, the job of finance is to get the money from your clients, your customers, to you as quickly as possible. But you, as a financial manager, pay your suppliers, your debtors, keep your money as long as you can and pay them the last minute before it's due. They're making money on money. Okay, offer customer discounts for paying early. Take advantage of special payment terms from the vendor if it's only beneficial. If I got special terms, I got to buy more supply inventory, and I can't move that inventory to a sell-through. More inventory, no customers. It's not going to help me. I'm going to lose money. Remember, it's only a good deal if I got customers that will buy my inventory, and I could turn my inventory within a certain month. Remember, when we were looking at inventory that we talked about before earlier in the class, inventory is looked at annually, but you have to look from a retail merchandiser on a monthly basis and look like a sell-through. If sales are down, I don't need more inventory. This is what Walmart's doing back there when they're adjusting their inventory. They say, hey, our sales are down, but our inventory cost is going down. Wait a minute, it should be a proportional relationship. You should have some more inventory than you needed because there's going to be a lag to collect it, but not that large of a discrepancy that they were looking at. Oh boy, we got a lot. Let's get going. Okay, sorry. Types of short-term financing. You got credit trade. Practice of buying goods, service now and paying for them later. You got 2% 10, net 30. Then you pay the full amount. Promissory notes is a written contract agreement to pay a supplier a specific sum of money at a definite time. So they may give me the goods, and I got a little leeway before I have to pay them back. Okay, friends and family. One thing to remember about friends and family: they love you, but they don't ever expect you to collect on the money. So here's how I have to deal with friends and family. Agree to specific loan amounts, just like you would, as a bank. Put it in writing. Doesn't have to go to the formal, but you write it. Remember, this is verbal, even the written. They sign up, and you have witnesses. And it can't be, all right. It'll stand up. The other thing, because sometimes you see like Judge Judy or some of the other judges on thing where you have family members trying to collect money from their siblings, their loved ones, they're fighting for $50. Go, just don't talk to the guys. That's fine, it's family. But I can see if it's a lot of money. Put it in writing, the same way you would for a bank loan. Okay. Okay. What else we have? So we have different forms of short-term loans. I don't know why I did that way. Let me just go this way real quickly. I just want to look. I'm live here. I just want to make this because it'll be easier to see. Okay. All right. So here's what we have. If I have different forms of loans, you have commercial banks, and they give you secure loans, real easy, backed by collateral. You got some collateral. Unsecured loans is we talked about your in personal finance, your leverage, your credit worthiness, your brand name, something that you could have. You have a line of credit with a given amount of money the bank will provide you so long as the funds are available. You have a line of credit out there. So if they dry up under funds, they reduce your line of credit. But it's good because you don't always have to go for a short-term loan to get your inventory. You have a standing line of credit. You use it, and you say, okay, I've used so much, and then when I sold my inventory, I placed the money back, and then my line of credit is back. Let's say it's 50,000. I always try to keep it at 50 after inventory. Look at a short-term loan, put it back, and keep it down. Okay, your credit cards, whether you like it or not, half a small business or finance start with credit cards, but make sure if your business goes under, they go after your personal assets. Risky, costly, and should be your last resort. And it should be all over here like that. Okay. Okay, now revolving credit agreement, a little different. A line of credit is guaranteed but comes with a fee. So I got where you look at this line of credit here, there's no fee. It's just out there. The only fee is when you use it and you pay the interest on it, whatever it is. A lot of times it's a variable rate. And you can later on lock it in if you want. A revolving credit comes with a fee. Same amount, but you always guarantee that amount, but you have to pay. Whether you use it or not, you're paying me a maintenance fee, for lack of better words. Other financial institution, they talked about factoring. Now, factoring is selling accounts receivable for cash or buying accounts receivable at a discount rate. We don't know buyer or seller. Factoring charge more than banks, but many small businesses don't. Don't qualify for loans, so they have no choice but to sell their accounts receivable. They got the customers, it's their own. It's not like a MasterCard, Visa card. They have their own credit card, their own accounts receivable, and they need the cash, so they'll sell it at a discount rate to somebody else. And then commercial paper is an unsecured promissory note for $100,000 and up, matures in 270 days or less. You have to have a pretty good credit for them to give you commercial paper without any kind of collateral. Okay, so ways to raise capital for startups is seek out a micro loan from a micro lender, and you could find them, the small ones. Sweet talk vendors, you want to do business with them. Research local banks. Turn to the web and seek out peer-to-peer lending. And let's say use assets. I'm gonna go look. I'm just gonna kick on this one on Kickstarter. And the reason I want to open this, let's see if it opens. I just want to show you what people are doing. Okay. Now, if I look at Kickstarter, look, Fasten the Project, funded 94%, is looking for 47,000. He has 61 backer. Revenge One Shot, looks like a video game. He find out 81% funded, more than enough. A multi-purpose, all occasional greeting cards, overfunded, something like this. Mud, water, grounding, street dance theater, kind of interesting here. Not too good here, but got 80 backers, 45% funder. High stuff is this one, a staff picks film, apparel. Fine. All these, what does this thing do? A staff picks game. All I'm saying, you see, you could go under, you can't get a bank, utilize it. There's the way it works, it's not that hard, but it's good for smaller loans that you need. And you're only paying one person back, just charging a fee, and they will distribute what's the other backers, what percentage or how much money they get back. Okay, how companies fail to raise capital. There's no formalized business plan to show the need. We're doing a feasibility. Before we do a full business plan, is it feasible? Forget about the cost to open up the business and all that. Let's just assume that aspect is there. You have that money. Now I open it up. Will it be sustainable for the next 2 to 3 years? 5 years is preferable. I don't want to open up and it goes belly up. I spent all that money, lost it. So there's two aspects. One to acquire the funds. The other one is sustainability. So I still need a business plan. Good idea. We're going to invest in you. Who is the management? Who's the customer? Have you thought this out? How are you going to market? How are you going to do that? Everything you do in the feasibility plan is just a micro of a business plan, just to make sure. And then when you do the business plan, then we go into more detail. So if you take me for entrepreneurship or small business management, we'll go into more of a detail on a what do you call it, a business plan. Some of you who've taken this course, let's say 3-4 years, if you look at some of the old videos, I made you students do a full business plan. But that's kind of a little harsh right now because this is an intro to the class. And so I'm trying to just now, let's look first. Many people got an idea. Forget about the funding. Let's look at it. Could it sustain itself? If it's sustainable only for a year, I fund differently. I get in and out and make as much and then try to sell it off or just close up the business. Okay, setting long-term financial objectives. What are the goals of the organization's long-term objectives? What funds do we need to achieve the firm's long-term objectives? What sources of long-term funding capital are available? And which one best meets our needs? Now this one here is the same thing we talked about personal finance. Character of the business of the borrower, right? Capacity, the borrowers, the business that could pay back the loan. Capital, being invested by the business, by the borrower. How much do I put in or I have other investors already involved? Conditions of the economy, the firm's industry. I'm open up. Is the economy picking up? And is that a product or a need that needs to be satisfied by that I'm providing a need or a service for a need that looking for something to be satisfied by a consumer. And then collateral, what do I have for collateral? And then long-term financing, again, we'll go real quickly. You have debt financing, and if I look how do I get debt financing, borrowing from lending institutions, long-term terms, because debt, what they're talking is from borrowing. Debt is basically I borrow money, IOUs, either from a bank or whatever, okay? Now, issuing bonds, I could issue bonds. Remember, bonds from accounting is the stepchild or sister, if you want to call it, from the stock market. Issue bonds, secured bond or unsecured. And then your bonds are terms of agreement in the bond issue. Secure bonds has some sort of collateral, usually real estate or something. And it could be a brand, it could be a name, it could be something that has value to it. Unsecured debtor bonds are backed only by the reputation of the issuing company. Okay? Can't get this to move here. I'll leave it here. All right, so did we cover that, issuing bond? Okay, so that takes care of one way through debt. Now let's look at equity. Equity, I don't want to borrow no money. I don't want to borrow no money. I'm strong. I don't think borrowing. Remember, in business and everything else, if you follow the golden rule of finance, the way finance is, you should only borrow what you need to make more money. But if I borrow just because I want to make the office look nicer, because I want something else, I should not borrow. I should save for those items, put it to retain earnings if you can, or bring another partner or do something on that, okay? So equity financing. Internally, how could I do that? I could retain earnings. I could ownership contribution to stocks. Okay, I could bring in a partner, sale, a partnership. Now, external stocks. I could do an initial public offering, IPO, and we've talked about that, and we will in investment in chapter 19, if I'm mistaken. I want to attract venture capitalists. You better show them. Remember, venture capitalists got money that he or she wants to invest in. They want to invest in your product, they want to get a return on investment, and they want you to come back with more requests for more money. They're looking at that person. So they want a person who they see growth potential. Not only in your product, but as your product grows, because you have a good plan, a good idea, and they could see that as a return and a good source of income for their own operations. Okay? Can a company grow? Will we get our money back and more? Will it be worth our money and effort, not only now but in the future? Okay, charts the differences of equity. Here's the chart. If I look at this, and then I'm not going to go through that. You can look at that. Different conditions, repayment, debt. So debt you have to pay back, obligation, contractual obligation, interest is taxable. This was no stock, no maturity. Company never required to repay equity. Firm isn't legally liable to pay dividends. Dividends are paid after taxes. Income are deductible. So look at that, and I'm not going to go into too much, but you can understand it. Now chart using debt versus equity, and here's additional debt. Year-end ending, and you can see the cost or the loss for the same amount of money utilizing either debt or utilizing equity. Which one has a better return on the investment? And I would go with the equity all the time. Okay. because you don't own anybody. But it has to look at the numbers. Sometimes you may want to look, if I'm going in here, on here, if I'm making too much money, I need a tax break. Shit, then I'm going to go with the additional debt. And you see, a lot of companies will buy the building, and if they already have a lot of capital investment, they're too heavy in the capital to change the number. They'll buy the land, buy the building, and then they'll turn around and lease it back to a third party with an option to buy in 25 years. In the meantime, they could write everything off as a lease, and it doesn't show on their books as a capital investment that increases that ratio that they're looking at return on their investment. Okay? All right, so now let's go into leverage. When I look at leverage, and it ties into the 5 C's that we had in here, your character, your capital, your conditions, and forget the collateral. So if I'm looking at leverage, raising funds through borrowing to increase the firm's rate of return by things that I have. I'm leveraging either my name or something else to improve my rate of return. Now, cost of capital is the rate of return a company must earn in expectations of equity holders in order to meet the demands of the for lack of better, order to meet the demands. Oops, got to turn around. Sorry, demands of its lenders. Okay, so I think that covered that. What else? Oh my goodness, we finished everything. I knew this would happen. We're doing very good. Now let me just bring this down so I could summarize this. And for those who are looking, I'm using a program called MindJet. And it's an interactive program. I use a lot of concept maps and mind mapping. When I take notes, I can see the whole picture and I can see the connections. It helps me, helps for presentations like this. I could cover a lot of material without showing you a lot of pictures, but just right to the fact, and you can see the relationships between different concepts and how it all ties into this chapter we're talking about. Financial managers. There's other programs out there. You can buy them. You can get them online for free. But remember, you get what you pay for when you get them. When you get things for free. Okay, so what do we have here? Okay, so I have this. Let me just make this a little bit smaller so we can get this in. Okay, I'm already finished here. I'm done. Sorry. Okay. All right, we covered everything else. Chapter 18. I think we have chapter 19. We're going to be investments. We're going to talk about stocks, bonds, initial public offering, everything you want to know about investments. And then we'll have another chapter 20. I think it's in Federal Reserve or the banking industry. And then you'll be done. You should, by this time, already have your feasibility paper almost pretty darn close, because the papers will be due in a few more weeks. Right after the last chapter in 3 weeks, 4 weeks. So let's work on this. A lot of you, this is probably your first exposure to accounting, because it's introduction to business organizations. I expect the numbers to be fairly close. I'm not that harsh looking at the numbers, since some of you haven't had accounting and experience in finance, but I'm looking at the line items that you've identified those. The numbers, don't tell me that you're gonna you open up a business, a hot dog stand, you're gonna make $1 million a month, whatever. Come on, give me a break. You're selling something else other than hot dog. Be rational, realistic, and even though the numbers aren't there, I'm not worried. I'm looking at the line items. I want you to understand conceptually what's going on, so that things will work out. All right. So again, my name is Dr. George Mochocki. This is Introduction to Business Organization. We finished covering Chapter 18, Financial Management. We're all Chief Financial Officers. You're either taking me in an online class or face-to-face class at a community college. I teach both at College Lake County and in Harper, a similar class, maybe different books, but it's business, into the business organization. This is all the functionalities. I don't care what business you're in. They all have to have the same template. And just maybe a different perspective, different examples the authors use. Okay, so look me up, and if you can't take my classes, that's how I pay off my student loans. So if you can't take me, look up at another community college. Do the best for your money. You get experts, you get people out of their field that know their background, and they will you get good value. You already pay taxes. It's local. They could fine tune it to your community, to your environment, and everything else makes sense. All right. So I'll see you in the next chapter. Again, my name is Dr. George Mochocki, and enjoyed spending some time with you. Bye.